Welcome to the deep dive. Today we're moving past the static lines on a chart and getting into the real-time mechanics of market movement.
Yeah, that's right.
Our mission is to really understand that battle happening inside the order book, to show you how professional traders confirm if a level is, going to break or if it's going to hold strong.
We're trying to take the guesswork out of it.
Exactly.
We looked at a whole stack of sources, all focused on order flow, which is, it's the crucial signal that confirms whether the market actually has the conviction to move.
Okay.
And we've distilled it all down into two really actionable concepts. The offensive move, which is called absorption, and the defensive one, the low volume node, or LVN.
And this isn't just a, textbook theory. We're going to unpack the visual proof, the intent of the market, using tools like order flow, heat maps, and volume profiles.
Right.
By the end of this deep dive, you should be able to look at a chart and spot that exact moment. The moment aggressive smart money decides to make its move. And that helps you tell the difference between a classic retail fake-out and a genuine confirmed breakout.
Let's get into it.
So let's jump straight into that breakout battle, because this is where I think most traders get burned. You see a clear resistance line, you maybe short that level, thinking it'll bounce, and then boom, the price just blasts right through it. Your wall just failed. On a normal chart, that's just confusing. Why does resistance seem to lie so often?
Well, what's fascinating here is that on a candlestick chart, resistance it's just a flat line, it's static.
Yeah.
But when you switch over to something like an order flow heat map, you realize that resistance isn't one-dimensional at all. It's a tangible barrier of liquidity. The sources we looked at describe it perfectly. It shows up as a floating wall.
A wall.
Yeah.
So tell me more about what this wall is actually made of. What are we seeing visually on the heat map?
You're seeing these massive horizontal orange and red lines floating just above where the price is trading. And those lines, they represent passive limit orders.
Passive. Okay, what does that mean?
It's critical. These are sellers who are patiently waiting at a specific price. They've told their broker, look, sell my contracts if the price gets to X, but I'm not in a hurry. They're forming that kind of you shall not pass barrier.
So they're not chasing the price?
Not at all.
Yeah.
Because they're passive, they aren't paying the fees for immediate execution, which is why institutions will often use them to quietly build a position or defend one.
Okay, so those passive sellers, they create the structure of the wall. And I guess most retail traders see that structure and just automatically think, okay, sell zone.
That's the trap.
But that's when we have to start looking for the attackers, right? The source of the potential breakout.
Exactly. If you're trading just based on that static price action, you are completely missing the immediate dynamic of the battle. The attackers, they show up as these very visible green bubbles right underneath that passive wall.
And these green bubbles, they're the opposition. What are they doing that's so different from the patient passive sellers?
These are aggressive market buy orders. You'll often hear them called smart money because their actions show real intent and urgency.
So they're not waiting.
No, unlike the passive sellers waiting for the price to come to them, these aggressive buyers are actively hitting the ask. They don't really care about getting the best price. They care about getting filled now. They're literally attacking the passive sellers, consuming every single contract that wall has to offer.
Wow. I can just imagine watching that visual battle unfold in real time, especially if you just decided to short that wall.
Oh, it's incredibly tense. And this brings us right to the core concept of this whole segment. When you watch the case studies, the key signal is seeing those green bubbles get consistently larger and larger as the price grinds into resistance.
So it's not just one big bubble, it's sustained pressure.
Sustained aggressive consumption. And that process is what we call absorption.
So absorption is the visual proof that the supply, all those passive sell orders, is being systematically eaten away by aggressive demand.
Precisely. Think of the wall as, a massive block of ice.
Okay.
The aggressive market orders are the heat, melting that block piece by piece. The aggressive buyers are stepping up, they're showing their conviction, and they're willing to pay whatever it takes to consume that liquidity. The wall only holds if more sellers show up to refill it.
But if they don't...
If the consumption continues faster than the refill rate, the sellers just get exhausted.
And what happens then? What's the immediate result when that massive wall of liquidity is gone?
The visual is just stunning. The red and orange lines, they just vanish.
Gone.
And that's your definitive signal. Once those passive sellers are depleted, there's basically no friction left to hold the price down. The buyers who are just absorbing have cleared the path, and the price just it instantly breaks out and flies into the next zone.
This completely moves the decision away from prediction, doesn't it? We're
Yeah,
not guessing if resistance will hold.
you're observing supply exhaustion.
We're watching it happen.
That's the key takeaway. Static resistance, it defines the potential location of the battle, but order flow, specifically that visible, sustained process of absorption, that confirms the winner of the battle.
And triggers the trade.
And triggers the trade. If you see those huge, sustained green bubbles eating the red lines, you are watching a confirmed breakout in the making. The instruction is clear. Do not short the wall. You join the aggressive buyers.
Okay, so we've established how order flow confirms a successful attack and breakout. Now, let's flip that dynamic completely.
The defense.
The defense. How do you confirm that a falling price is going to find real, reliable support and give you that powerful bounce? For this, we have to look at market structure, specifically this idea of the low-volume node playbook.
Right, and this setup is maybe even more insightful because it forces the trader to perfectly combine two very distinct tools. Step one is all about establishing the structure, and that means identifying the low-volume node, the LVN, using a volume profile.
So most people know volume bars at the bottom of a chart. The volume profile turns that on its side, showing volume at each price level. What exactly does a low-volume node look like there?
On the volume profile, which is just measuring the total contracts traded at each price over a certain time, the LVN is a deep valley, a dip.
A gap.
A gap, exactly. It's an area where the market previously spent very little time trading. The source we saw pointed to this thin range on gold. I think it was between 4,200 and 4,190.
And why is that lack of trading history so important? I mean, why would an LVN act as such a strong barrier?
This is the part that often gets glossed over. The LVN represents an area of market rejection.
Rejection.
It means that previously, when the price moved through that zone, traders decided very, very quickly that the price was either too cheap or too expensive, and they just moved away from it fast. They found no acceptance there.
I see.
So because the market rejected that price range before, the idea is that if price comes back to it, it's likely to be rejected again. It's like clear air for price to move through.
So the volume profile gives us the historical map. It shows where the market previously said, nope, not interested in trading here. That sets our predicted spot for a bounce.
Exactly.
But, like we just learned, predicting a level isn't enough. How do you know that that falling knife is actually going to hit a safety net and not just smash right through that LVN structure?
And that's step two, the confirmation. This is where the structural prediction meets real-time market intent. The trader, in our case study, they switched over to Bookmap, the visual liquidity heat map, to make sure that LVN wasn't just some hollow historical line.
They were looking for a live firewall.
A live firewall, that's a perfect way to put it.
And what did that firewall look like on the heat map as the price was dropping down toward that 4,200 LVN?
Well, as the price got close, the heat map just lit up. A bright, dynamic orange band appeared right at the bottom of that node.
And that's the safety net.
That is the safety net. That orange band represents massive, passive buy limit orders waiting in the book. You're literally looking at a wall of buyers, probably institutions, ready to defend that low-volume structural level.
That is just a beautiful synthesis of these tools, isn't it?
It's perfect.
The volume profile tells you the high probability location based on historical rejection. But the order flow tool, Bookmap, gives you the real-time confirmation of the liquidity of that safety net you need to actually execute.
One tells you where, the other tells you when.
Exactly. And then you watch the execution happen.
Right. So the aggressive sellers, they push the price down, diving right into that LVN, and they run smack into that huge passive orange wall of buy limit orders. They try to push further, but they just find an endless supply of contracts from the passive buyers. We could almost call this reverse absorption.
So the passive buyers are absorbing all the ammunition from the aggressive sellers.
Correct. The aggressive sellers, who were so desperate to push the price lower, they're now just exhausting their supply against the patience of the defending buyers. They hit the wall, run out of steam, and because the LVN means there's clear air above, no real resistance to hold it down.
It just snaps back.
The price reverses instantly. The sellers are exhausted, and the market just rockets back up.
The lesson here seems paramount for managing risk. You never try to catch a falling knife blind, just hoping some historical line holds up.
Never.
You use the low volume node to find your spot, your high probability location, but you have to confirm the presence of that massive defensive limit order wall on the heat map before you pull the trigger.
That liquidity confirmation is everything. It's the difference between a high-risk gamble and a high-conviction trade.
So we've seen two sides of the same really powerful coin here. a confirmed resistance break using aggressive absorption.
And a confirmed support bounce using a low-volume node backed up by passive limit order.
Right.
And these two cases, they really highlight a single unifying principle for modern order flow analysis. If we combine our historical perspective, the structure, the volume profile, with our real-time intent perspective, order flow and liquidity.
The conclusion is pretty clear.
It's crystal clear.
Wow.
History defines potential, but visible, live order flow determines execution timing.
And that's really the key shift, isn't it? This moves trading away from being a predictive game where you're just guessing what might happen based on old patterns to a proactive, reactive strategy.
Right. You only execute when you have seen the intent of the largest market participants confirmed.
Confirmed through the mechanics of liquidity consumption.
It lets you position yourself at the exact moment of exhaustion. In the breakout, you see the sellers run out of ammo. In the bounce, you see the aggressive shorts run out of steam.
You're waiting for the battle to be over before you step onto the field.
Precisely.
So this deep dive gave some really foundational insights into the market's plumbing. We covered the passive limit orders that make up the defensive walls.
The aggressive market orders, the bubbles.
And those two critical dynamics,
Mhm.
absorption, which is the consumption of liquidity that leads to a breakout, and the structural importance of the low-volume node, the LVN, as a high probability spot for defense.
And we really focused heavily on successful confirmation. The aggressive buying worked, the passive defense held.
Right.
But if we connect this to the bigger picture of market conviction, that leads us to a pretty provocative final thought.
The counter scenario. What happens when the attack just fails?
Exactly. What if the smart money green bubbles step up and they launch a huge, high-volume, aggressive attack on that resistance wall, on those passive sellers?
Okay.
And yet, despite all that urgent effort, the wall doesn't vanish. The passive sellers just hold firm, and maybe they even refill their stack.
So the aggressive buyers run out of steam. They fail to consume the resistance. The attack fails.
That failed absorption, that signals an incredible conviction from the passive sellers to defend that level, even after absorbing a huge amount of volume. So what's the immediate consequence for those aggressors who just showed their hand and used up all their ammunition?
They're trapped.
They're trapped. The market instantly knows the path of least resistance is now violently down. That reversal, sometimes it's called a liquidity trap, can be the most violent move in the market. The power behind failed absorption. Well, that's something worth digging into next time.
A perfect scenario to keep our listeners thinking. Thanks for joining us for this deep dive into understanding the real mechanisms driving price movement.